That's how much of Berkshire Hathaway's entire $347 billion equity portfolio is concentrated in just 5 companies. Not 50. Not 20. 5. If you've spent the last decade being told that diversification is the golden rule of investing, that spreading your money across dozens of positions protects you, then Warren Buffett just called your entire strategy into question. And the uncomfortable truth? He's been running this concentrated playbook for over 30 years. His net worth is $140 billion. Yours probably isn't. So the real question isn't whether Buffett is concentrated. The real question is, why does that strategy work for him? And is it quietly destroying your returns? There's a signal buried inside Berkshire's 13F filings and shareholder letters that most retail investors walk right past, and it has nothing to do with which stocks Buffett is buying. It's about how he sizes positions, the logic behind the concentration, the specific conditions he requires before he puts serious money to work. By the time this video is done, you'll understand the actual framework, not the watered-down version financial media recycles every quarter. And you'll be able to make a clear-eyed decision about whether any part of this approach belongs in your own portfolio. Because copying Buffett without understanding Buffett is one of the most expensive mistakes a retail investor can make. Let's get the numbers on the table first. As of Berkshire Hathaway's most recent 13F filing, Q4 2024, the 5 largest positions are Apple, American Express, Bank of America, Coca-Cola, and Chevron. Together, they account for approximately 70% of the entire equity portfolio. Apple alone sits at roughly $75 billion. That's nearly 28% of the whole book. Even after Buffett trimmed the position significantly through 2024. At its peak in 2023, Apple represented over 50% of Berkshire's portfolio. A single stock, more than half the equity holdings of one of the largest investment vehicles on earth. Now here's why this moment is unusual. The conventional wisdom in portfolio management, the kind taught in every CFA course and repeated in every robo-advisor pitch, is that proper diversification requires somewhere between 20 and 30 uncorrelated positions to eliminate unsystematic risk. Modern portfolio theory, efficient frontier, the whole apparatus. Buffett has called that framework, and I'm quoting directly from his 2021 shareholder letter, nonsense for those who know what they're doing. That's not a man hedging. That's a direct challenge to the foundational assumption most retail investors have never questioned. This directly affects you if your portfolio looks like a typical retail account, scattered across index funds, sector ETFs, and a handful of individual names, all in the name of safety. The financial press frames Berkshire's concentration as the privilege of genius. The narrative goes, Buffett can afford to be concentrated because he's Buffett. He has access to information, management teams, and deal flow that you don't. His Apple bet worked because he saw something no one else did. This interpretation is comforting. It lets retail investors off the hook. Don't try this at home. Stick to your diversified index fund and let the professionals do the concentrated stuff. But that reading is intellectually lazy, and it misses the actual lesson entirely. Buffett's concentration isn't random genius. It's a repeatable framework with specific entry criteria. Look at the 5 holdings. Coca-Cola, held since 1988, over 36 years. American Express, a position that dates back to 1964, 60 years. These aren't trades. They're permanent capital allocations to businesses with durable competitive advantages, pricing power, and high returns on invested capital. Buffett himself has stated the framework explicitly. Diversification is protection against ignorance. It makes very little sense for those who know what they're doing. The operative phrase is know what you're doing. His concentration is the output of deep, specific knowledge about a small number of businesses, not a bet on momentum or a macro thesis. Here's the data point that cuts through the noise. Berkshire's 5-year annualized return through end of 2024 was approximately 19% per year, compared to the S&P 500's roughly 14% over the same period. That's not luck compounding. That's a structural edge. While retail investors have poured money into broad market ETFs, and total US ETF assets crossed $10 trillion for the first time in 2024. The world's most scrutinized investor is doing the exact opposite. He's concentrating more, not less. And he's not alone. Stan Druckenmiller, widely considered the greatest macro trader alive, has said publicly that diversification is diversification for investors who have genuine conviction. Bill Ackman at Pershing Square runs a portfolio of roughly 10 to 12 names total. The institutional behavior pattern is clear. The investors with the best long-term track records tend to run fewer positions with higher conviction, not broader exposure with diluted bets. While retail was building 40 stock portfolios, the professionals were doubling down on their best ideas. But here's the part the consensus is getting wrong. Everyone who covers this topic frames it as a question of how many stocks to own. They debate 5 versus 20 versus 50. They argue about diversification ratios and correlation matrices. That's the wrong argument entirely. Buffett isn't concentrated because he's brave. He's concentrated because he has spent, in some cases, decades studying individual businesses before deploying major capital. His Apple position didn't start at $75 billion. It started with a small exploratory position in 2016. He watched it. He stress-tested his thesis. He added aggressively as his conviction deepened. The concentration was the result of a process, not the strategy itself. Here's what the data actually suggests is happening. Most retail investors who attempt to run concentrated portfolios get the output without the input. They concentrate on 5 stocks based on earnings headlines and social media chatter. Call it high conviction, and then panic sell the first time one of those positions drops 20%. Buffett held Coca-Cola through a period in the 2000s where it went nowhere for nearly a decade. He didn't move. Why? Because his conviction wasn't based on the stock price. It was based on the business. If this view is correct, and I believe it is, then blindly copying Berkshire's top 5 holdings without the underlying research discipline doesn't give you Buffett's returns. It gives you Buffett's volatility without Buffett's patience. That's the most dangerous position in investing. The implication is direct. Concentrated portfolios in the hands of undisciplined investors significantly underperform diversified index funds over any 10-year period. The data on this is consistent across academic literature. So what does this actually mean for how you manage your money? And here's the question this entire analysis leaves open. Buffett has been trimming Apple aggressively, selling over $100 billion worth of Apple stock through 2024 while building Berkshire's cash pile to a record $334 billion. If the man who built one of history's greatest concentrated portfolios is deconcentrating right now, what does he see that the rest of the market is missing? That's the real story, and it's one we'll dig into next. So here's what I want your take on. Buffett's $334 billion cash pile is proof he sees a major market correction coming in 2025. Or do you think he's simply holding dry powder because he hasn't found a business worth owning at the right price? Drop your position below. The best analysis always comes from the comments on this channel. If this reframed how you think about position sizing and conviction investing. The next video goes even deeper into the one metric Buffett uses to decide when a position has gotten too large. and why understanding it could be the single most valuable risk management tool in your entire investing process. That video drops this week. You won't want to miss it. This video is for educational purposes only and does not constitute financial advice. All data referenced is sourced from publicly available SEC filings, Berkshire Hathaway shareholder letters, and publicly reported market data. Always consult a qualified financial advisor before making investment decisions.